Welcome to the latest edition of our Fixed Interests podcast series. I'm Rookmaaker, head of Asia Pacific Sovereign Ratings, and today I'm joined by Jeremy Zook, a director in Fitch's sovereign team and lead analyst for China. We'll be discussing the rationale for the recent downgrade of China's sovereign rating to single A with a stable outlook. So Jeremy, what were the key drivers of the downgrade?
Yeah, thanks, Thomas. So the key factor behind our downgrade was essentially our expectation that we'll see a continued weakening in China's public finances and a rapidly rising public debt ratio in the coming years as the economy continues its economic transition away from the property sector. We think that sustained fiscal stimulus will be deployed to support growth amid subdued domestic demand, rising tariffs, and deflationary pressures. So this fiscal support, along with pretty significant structural erosion in the revenue base, will keep fiscal deficits fairly high in the coming years, and this will drive the government debt ratio further upwards, especially combine that with an ongoing crystallization of contingent liabilities and a relatively subdued outlook for nominal GDP growth. So we've already seen this pretty significant deterioration in both fiscal deficit and government debt ratios. The fiscal deficit in China is well above that of its rating peers. And the debt ratio is now surpassing the peer median level and is going to continue on an upward trend in our medium-term forecasts. Now, despite this pretty significant deterioration in public finances, China does still have a lot of fundamental credit strengths, has a very large and diversified economy, fairly solid growth prospects relative to its rating peers, and it plays a very integral role in global trade and does have very robust external finances. So these strengths, we think, should balance these ongoing fiscal challenges at the new rating level. And I guess when we think about other risks, of course, reciprocal tariffs and the sharp increase in U.S. tariffs on Chinese goods does pose some downside risks to our growth and fiscal forecasts for this year. But again, we do think there is headroom at the current rating level to accommodate these impacts.
So China's economy is still facing challenges on the domestic demand side and is now also facing the external headwinds of the US tariffs that you just mentioned. So what's our outlook for the economy this year?
That's right. So China's economy is in a bit of a challenging position. The domestic economy is still trying to find its footing. And add to that now the sharp increase in tariffs by the US and significant headwinds coming for external demand now as well. We forecast growth this year to come in just under 4%. We've just revised this down in the face of the recent April 2nd tariff announcements. I want to turn first to the domestic side, though. When we look at China's domestic economy, the property sector is still kind of central to the domestic outlook. And here we expect a further correction in 2025. Now, that correction is gradually dissipating, so we see less of a drag when it comes to the property sector this year, but continued headwinds in that area nonetheless. The pretty significant property correction over the past couple years, along with kind of an erosion of income and employment expectations among households, has really dampened consumer confidence in China as well, and that's spilled over into consumer spending. So these two factors combined has just meant a fairly weak domestic demand environment in China. Now, over the past couple years, external demand has been a key growth driver and sort of offset some of these domestic weaknesses. But now, because of the increase in U.S. tariffs, that tailwind is going to dissipate and now turn into a challenge for the economy in 2025. So, that I think has really come as a key factor for our downward growth revision from 4.4% to 3.9%. When we look at what can the authorities do in terms of offsetting these new external challenges, well, we do expect more monetary policy easing to try to spur domestic demand and domestic credit expansion. We do expect that there will be some further depreciation in the yuan against the US dollar, but here we do think the authorities will be a bit cautious as they also have to worry about their trading relationships with other countries and don't want to see too sharp of a depreciation against the dollar. So really, it will come down to fiscal policy and using fiscal stimulus to offset some of these new external headwinds along with those domestic demand shortfalls.
Could you say a bit more about the role that fiscal policy is likely to play in supporting the economy this year? And what are expectations for the fiscal deficit?
Yeah. So when we look at the fiscal deficit at Fitch, we do an augmented fiscal deficit that looks at the 4 budgets that the Ministry of Finance presents as part of its annual work plan. So this is the official budget deficit, the government funds budget, where things like infrastructure and other spending is included, the Social Security balance, as well as a SOE fund balance. And so on this basis, we forecast the fiscal deficit to rise to 8.4% of GDP from 6.5% of GDP last year. So this is already a fairly significant increase in the fiscal deficit. And the fiscal deficit is already now quite high compared to its rating peers, where the peer median is 2.7% of GDP. And certainly since the pandemic, China's fiscal deficit have been quite high, averaging 6.5% of GDP over that period, compared to just around 3% from the period of 2015 to 2019. So I think a few key things to highlight for the fiscal support this year. The government is focused on trying to boost consumption. So they have a consumer goods trade-in program of about 300 million yuan. That is a continuation of something that they put in place last year. They are also looking to provide local governments the ability to use special purpose bond proceeds to purchase empty or unused property developments to try to help support the property sector. But, still a bulk of the fiscal support does seem to be tilted towards infrastructure and ongoing supply side expansions. We also think that with the significant rise in tariffs imposed by the US, which goes well beyond our baseline, that there's a high likelihood that the government will have to step in with additional fiscal support this year and perhaps next.
So the government has also been focused on managing hidden debt risks from local government financing vehicles or LGFVs. Could you elaborate a bit on some of the measures that have been taken and how these measures impact China's public finances at large?
Yeah, local governments in China have been under pressure when it comes to managing some of their hidden debt risks over the past couple years. And this has proven to be a bit of a constraint on local governments' ability to deploy fiscal policy and for them to manage fiscal risks, especially when it comes to these LGFEs. So in November of 2024, the central government outlined a plan to help local governments manage these hidden debt risks. And that plan centered around essentially a debt swap, bringing debt from LGFEs onto local government balance sheets directly. They outlined a plan for about 10 trillion yuan in debt swaps over a 5-year period. So about 6 trillion, about 2 trillion a year in sort of new additional allocations of borrowing capacity for governments between 2024 and 2026. And then about 800 million a year between 2024 and 2028 in special purpose bond proceeds that could be used for debt swaps. So in all, this is just over 7% of GDP in debt swaps. So that essentially brings the local government debt up 7 percentage points. So a crystallization of contingent liabilities. In a way, this kind of addresses some long-run concerns that we've had around contingent liability risk in China. But still, it's a relatively small portion of the overall outstanding LGFE debt in the economy. It's just under kind of a quarter of IMF estimates of the level of LGFE debt. And beyond the LGFE sector, we do see further risks of contingent liabilities. But these debt swaps do free up some space for local governments to have some additional financing because they can finance at lower costs than the LGFEs can and no longer have to provide support in terms of helping LGFEs meet their interest payments.
To conclude, let's look at the public finances over the medium term. So how do we see the fiscal prospects and the outlook for government debt?
as mentioned earlier, China's fiscal deficits are relatively high at the moment, and we see the prospects for fiscal consolidation as being relatively gradual in the coming years. And there's a couple reasons behind that. First of all, we've seen a fairly significant and what we believe largely structural deterioration in revenue collection. Revenues as a share of GDP have come down from about 29% to just over 21% since 2018. A lot of that is because of sort of ongoing tax cuts that the government has rolled out, along with just the property sector correction. So reversing that revenue decline, first of all, will be relatively challenging, especially as the economy still faces some headwinds and it's difficult to significantly raise taxes. Beyond that, on the spending side, the government is looking to shift towards a more consumption-driven economy, especially as external challenges are rising. And this is likely to require additional spending when it comes to social safety nets and trying to get households to go out and spend more. So both of those factors together, we think will keep the fiscal outlook relatively challenging and leave space for only gradual fiscal consolidation in the coming years. So those high deficits and the ongoing debt swaps that we just discussed, along with a kind of challenging outlook around deflationary pressures. We've already seen 7 quarters of a negative GDP deflator. And we do kind of expect that to continue in 2025 and very gradually recover from here on out. So all of these factors together will keep government debt, that is, explicit local and central government debt per our definition, on a sharp upward trend. Debt has already risen from under 40% of GDP in 2019 to just over 60% in 2024. And we forecast this to rise further to over 68% this year and then 74% in 2026. By the end of our medium-term horizon in 2029, debt will be around 80% of GDP. And meanwhile, the rating peer median will remain in the high 50% of GDP range, which implies that there's a large and rising gap relative to rating peers. This challenging debt trajectory was really the primary factor for the downgrade.
Well, thanks a lot for your insights, Jeremy, and thank you all for listening. For more information on our ratings and on our research on China, please visit us at fitchratings.com. We hope you will join us for the next edition of Fixed Interests.